From New York City for our viewers worldwide, I'm Alix Steel in for Jonathan Farrow. You got big tech leading any rally in stocks. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up, big tech getting a big boost from NVIDIA's blowout results. And investors bracing for Jackson Hole with Chair Powell now on deck as Republicans target President Biden and the economy in Wisconsin. Let's begin with the big issue, the biggest earnings event of the year.
When you look at NVIDIA,
What we're seeing in NVIDIA is obviously very good news.
There's really nothing bad about that report.
they just completely surprised the market.
It's kind of a nice relief for a lot of investors.
Affecting the behavior of investors on a more of a risk-on mood from what we've seen in the past few weeks.
It's a very exciting story, a very exciting stock.
We're particularly impressed by the strength in data center.
They have a very dominant position in the data center.
Could the stock double? Of course it could.
We'd like to see another 15% move in the price.
The macro landscape is very favorable.
What NVIDIA is being very quite clear on is the demand will last into the foreseeable future.
I think you're going to see definitely a spillover effect.
Optimism in the AI theme again.
This wave around AI is not going to slow.
All right, let's get down to it. BNP's Megan Robeson joins us and Eric Nielsen of Wells Fargo. Guys, let's talk about this. Eric, do you have to chase this NVIDIA AI rally again? Do you have to chase the tech rally again?
Yeah, well, Alex, so our equity strategy team is still relatively positive on equities here. And part of that story is we see a little bit more downside in the rates complex, really across the U.S. in the near term. That, of course, tends to lift some of these more growth, duration-fueled stocks. So I think it sort of makes sense to see some of these trends continue. The question for us is, what is the 6 to 12 month horizon here for the Fed? What's priced into earnings here? As we get into next year, economics team's still calling for a recession and Fed rate cuts. And the question is, if we see more downside in rates, why is that happening? If that's not a great thing, then perhaps it's not so equity positive.
Okay, fair enough. So let's hold that there to a second. Go to Megan. Do you agree, Megan, that the path of least resistance for rates is actually lower?
We actually have an assumption that rates will stay higher for longer. So heading into Jackson Hole, we're not expecting a major policy shift out of the Fed. We do think they could discuss a higher neutral rate. If they do so, our economists expect that would be implemented by holding rates higher for longer here, and so well into 2024. If you look at credit markets, we are pricing in very low risks related to that. So we've rallied to the tights of the year at the end of July and now have bounced off of that a bit, but not much in the way of pricing expectations of higher rates.
We're going to delve deeper into Jackson Hole in just a second. But Eric, if we do wind up having, though, higher for longer, how does that affect tech? Because there was a conversation earlier this week that NVIDIA was actually leading the rates volatility rather than the other way around.
Yeah, certainly the higher for longer narrative would be a risk to our equity strategy team's view. And also it's a question of, I think, what's driving the rates higher move? Because if it's growth being stronger than expected and that continues to kind of support the earnings narrative, and it's not necessarily the worst thing in the world. So a lot will hinge on the Fed's communication and what its actual eventual action will be into the end of the year.
Okay, what sets us up before we go to Jackson Hole is the sentiment. Real quick, guys. Megan, what's the sentiment right now in the market as we do head into Jackson Hole?
So credit sentiment has been generally positive, and you've seen that in investor positioning. So our BNP credit positioning indicator is now at the longest level since pre-COVID. So as growth has surprised to the upside, we have seen investors add to risk, and that appetite has increased. So I think there is cautious optimism heading into the symposium.
For the market, what do you think, Eric? Is the sentiment a little bit too bullish now as we head in there because of NVIDIA? How's it set up?
Well, we've certainly seen a trend this year, Alex, of divergence between a couple of big names and the overall index as a whole. Thinking about Jackson Hole, and I'm sure we'll get into this in more detail in the next few minutes here, but I think there's some anticipation that Powell will talk about maybe higher structural rates, higher R-star. And if he doesn't do that, we're still in the summer doldrums. You could still well see some further risk on here to the extent that he kind of delivers a very ho-hum speech. Maybe he talks about something completely unrelated to the stance of policy, and it's a little bit more wonky. Certainly wouldn't be the first time. So I'm not necessarily sure that there's a clear downside risk here for risk sentiment.
So let's get to it. You both want to talk about it. We're going to do it. Jackson Hole officially kicking off today. Bloomberg's Michael McKee caught up with Jim Bullard, former St. Louis Fed president, earlier today.
There's some talk about base effects fading and going the other way during the second half of the year. I like to look at the 12-month numbers because they rinse out some of the seasonal effects. And so you could get at least a pause in the disinflation or even a little bit of reacceleration. I think that would suggest a higher rate profile for the Fed than otherwise.
Joining us now, Michael McKee from Wyoming. Hey, Mike, good to see you without the hat, which is weird, but let's talk about what people are talking about on the ground. What's going to be the topic? You got R-star, structurally higher rates, you have term premiums. There's a lot of stuff to get into. There's inflation and there's labor. What's the buzz?
I think basically what you're going to hear Jay Powell talk about is business as usual. They're going to continue monitoring the data that come in and decide on a meeting-by-meeting basis whether they need to tighten policy. Jim Bullard was the highest dot before he left the Fed, and he's still obviously quite hawkish about the whole thing. And he does make the case that the economy is much stronger than the Fed had anticipated. But it doesn't do Powell and the Fed any good to send the markets in one direction or another at this point, which is why I don't think they'll talk about many of the things that are being speculated on, like R-star, because any kind of suggestion that policy might change is going to lead to a belief on Wall Street that it will change, and people will start repositioning themselves. So he's probably going to just tell people what they have been hearing all along, that we're going to continue to keep rates high into 2024, and we're going to keep watching inflation and make sure it continues to fall towards 2%, and we'll make decisions as the meetings come along.
Do no harm, right? Like, don't actually send any signal whatsoever, Mike. Thanks a lot. Appreciate it. And that coming up tomorrow at 10 a.m. Megan and Eric still with me here. Megan, if we do, though, get higher structural rates for longer, when are we going to see that real deterioration then in the economy? And in your world in credit, like, where do those cracks emerge the most?
So, Alex, we've started to see some preliminary cracks emerge. It's just happened in the last few months, and the first places have been in the most rate-sensitive parts of the market. So, not surprisingly, leveraged loan defaults have creeped gradually higher. On a high-frequency basis, the three-month default rate for loans is annualizing close to 5%, so signaling that we are heading in the direction of a default cycle. You've also seen small and medium-sized firm bankruptcies, not necessarily with public credit, but you have seen bankruptcies there also climb higher. I think for the rest of the market, we are getting to the point where now interest expense is above earnings and at a level where, as maturities come due, you will start to see it start to impact areas outside of that most floating rate sensitive areas.
Yeah, just still waiting for it, though. You would have thought we already would have seen it. Eric, in terms of that point, if we do see higher for longer and we get that message again, kind of do no harm from Powell, where's the biggest misprice right now in the market?
Well, Alex, I think the narrative that the lags from policy have become shorter is maybe a little bit of a sort of ex post rationalization of not having seen a recession yet. I think those lags still work. They still take a long time. There's also still a psychological element of people expecting the Fed to pivot, and it's just not happening. So there is a clock running here with higher rates. It is having an effect, as Megan highlighted, in some of the default rates. So I think it's a broad macro story. I'm not sure it's necessarily one corner or another. It's another 6 months of Feds keeping policy on hold here. Is it change?
Well, let me flip it then for tomorrow. So, Eric, we've seen the dollar index over its 200-day moving average, a really strong move. And I'm wondering if we get a Powell that isn't as hawkish or isn't as toe the line as we think, is there some real potential downside there?
Well, Alex, I think the lags from policy have become shorter is maybe a little bit of a sort of ex post rationalization of not having seen a recession yet. I think those lags still work. They still take a long time. There's also still a psychological element of people expecting the Fed to pivot, and it's just not happening. So there is a clock running here with higher rates. It is having an effect, as Megan highlighted, in some of the default rates. So I think it's a broad macro story. I'm not sure it's necessarily one corner or another. It's Maybe from a very tactical standpoint for a week or two, because it's summer and we see some return of some of these high beta carry trades in FX, dollar selling, but the growth story in the U.S. is still the most compelling one out there. China is obviously headed the wrong direction. Europe increasingly is on the cusp of recession. The U.S. is hanging in there. So to us, the dollar is still a buy on dips, and we really want to emphasize that to our clients.
So the PMIs didn't scare you yesterday, I guess?
Well, the U.S. the PMIs, I look at the ISM a lot more because the PMIs were telling us in September, October that the U.S. is in recession of last year, and I think that was probably not the case.
All right, Megan, sort of a similar question to you, sort of the biggest misprice in your market, and I appreciate that you still see higher for longer. Where's the misprice, though, if we don't get that message tomorrow?
So I think the most mispriced thing in our market and credit markets is the compression that we've seen. So we have seen beta rally over the course of the summer. So lower quality, whether that's triple C's or high yield compressing versus investment grade. So the lower quality part of the market has seen earnings growth slow at a faster pace than higher quality. And as that continues and we sort of lose economic momentum, the PMIs that you cited as a signal for that, we would expect decompression across credit valuations.
Just in terms of today, the 30-year TIPS auction, should I be buying that, Megan? What do you think?
I think that real yields have risen a lot, so I think there is an attractive yield to be had there. And so far for credit, we've performed very well amidst kind of surprising rise in rates over the course of the summer. I think that fixed income traditional does also provide attractive carry relative to credit, and it goes along with what we were just talking about in terms of spreads being very compressed.
Yeah, looking at the 2-year sitting at 5, just straight up 5%. All right, Megan Robson and Eric Nielsen, you are sticking with us. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Abigail Doolittle. Abby?
Hey, Alex. Well, naturally, we will be starting out with NVIDIA, which is absolutely soaring, poised for a new record high on the open. And this, of course, on yet another blowout quarter. They put up about $13.5 billion in revenue, up 88% from the second quarter, beating the estimate that was a 50% rise in the last quarter. And there's also a strong guide for this current quarter of about $16 billion. That is up 170% year over year. A big number. Helps to explain why the stock right now and on the open will be up more than 220% year to date. Snowflake, also a beat, a smaller company, of course, but a software company. They held the guidance. Some analysts are excited about that. And then Tesla, this is interesting, Alex. After dropping from its July peak by about 29%, we're now poised for a 4th up day in a row. Elon Musk is out there saying the Cybertruck is Tesla's best product yet. Over the last 4 days, including today on the open, Tesla will be up about 10%, a little stealth rally there for Tesla.
That tech sentiment, if you can call Tesla a tech stock, I don't really know if that's true. Abigail, thanks a lot. I really appreciate it. Coming up, a GOP hopeful squaring off in Wisconsin.
The debate last night didn't really do anything to undermine President Trump's very secure position as frontrunner. This is sort of an introduction for those voters who might be other Trump curious, if you will, those sort of sometime Trumpers or never Trumpers who are looking for an alternative.
Republicans targeting President Biden and the economy in Milwaukee. That conversation up next. This is Bloomberg.
Joe Biden's Bidenomics.
Joe Biden has weakened America.
We must reverse Bidenomics.
The loss of $10,000 of spending power for the average family.
The war on energy.
Unlock American energy. Drill, frack, burn coal, embrace nuclear.
Runaway spending that launched the worst inflation in 40 years.
Reform the U.S. Fed. Stabilize the U.S. dollar.
We've got to deal with the long-term national debt issues.
It's time for an accountant in the White House.
GOP candidates making their debut in Milwaukee, taking shots at President Biden and his economic policies while leaving Donald Trump relatively unscathed. The GOP frontrunner making his own news in the pre-recorded interview airing at the same time.
I just felt it would be more appropriate not to do the debate. I don't think it's right to do it. If you're leading by 50, 60, I have one poll, I'm leading by 70 points, and I'm saying, why am I doing it? And I'm going to have 8 people, 10 people, whoever made the debate, I don't know how many it is, but I'm going to have all these people screaming at me, shouting questions at me, all of which I love answering, I love doing, but it doesn't make sense to do them. So I've taken a pass.
Bloomberg's Anne-Marie Hordern joins us now. Hey, Anne-Marie, what's the scuttle here? Who won this debate?
Well, it's a great question. There's really 2 people who everyone's talking about this morning as you flip through a lot of the networks and read a lot of the opinion pieces, especially coming out of the Wall Street Journal editorial board. I thought theirs was very interesting. One is that Vivek Ramaswamy seems that his personality, he seems to be one of the most Googled people today. He is someone who's not really well known to the establishment. But he did come up against some very difficult debates when it comes to foreign policy, especially against Nikki Haley. And she's the other one that everyone is really talking about this morning. Wall Street Journal editorial board calling her a pleasant surprise. We'll actually be speaking to her in the next hour. She had a lot to say about foreign policy and the economy, really walking a fine line, but giving the blows where she had to.
Yeah, it was very, and also what I found interesting too, talking about Biden economics, she also came out against fiscal discipline, but also blamed the GOP for massive spending as well. Yeah. I usually don't hear that in a GOP debate.
Yeah, exactly. She was one of the few on the stage, or the only one on the stage, who also blamed the Trump administration, who VP Mike Pence, of course, was part of. And this is what she said. The truth is that Biden didn't do this to us. Our Republicans did this to us, too, when they passed the $2.2 trillion COVID stimulus bill. And she talked about the trillions of dollars Trump has added to the deficit. And she said it was all these other people on stage who have been in Congress as well who have been voting to add to that deficit. So she came out with a lot of punches across the board in a number of places. And she's someone people weren't really expecting from. Everyone thought really this would be a potential make or break for DeSantis. Yeah. It just seems that it was kind of mute. You know, he wasn't trashed, but at the same time, he didn't really shine the way some others did.
Okay, before I let you go, Vivek Ramaswamy, is he running for president or at the bottom of the ticket?
Well, let's see at the moment. At the moment, he says he is running for president. He says that he cannot wait to be in the White House and lead. It's interesting to see where he comes out on this. You would think maybe he is running for VP if Trump does become the nominee, because he said yesterday that Trump is the greatest president we've seen in the 21st century.
Yeah, that was coming up to my mind, too. All right, Anne-Marie, thanks a lot. Anne-Marie Hordern. And coming up, as she was mentioning, 10:30 a.m. Eastern, Republican presidential candidate Nikki Haley joins Anne-Marie and Joe Matthew. Megan Robson and Eric Nielsen are still with us. Hey, guys, let's get to the whole idea of Biden economics. Megan, just pretend that Biden economics gets rolled back to some extent. What does that do to the economy?
So in terms of the economy, Biden economics, credit volatility has been very low. Part of that has been policy risk has really been in the background outside of monetary policy. So there has been deficit spending going on in the background. We think that has been a major factor in supporting GDP growth this year. As the election cycle comes into view, we are expecting that you could see more debate around that, and it will be a major factor in our GDP forecast. It's also going to be very important in terms of sectors. So typically in a political season, you'll see discussion around regulation of energy, financials, and tax policy. So those are all risks that we'll be watching in the year ahead.
What I also find so interesting is that a lot of red states are going to be benefiting from things like the IRA, as like solar panel building gets done there. And I'm wondering how that's really going to play out. Eric, to that point, if we roll back some kind of Biden economics, where do we feel that in the market? What's the impact?
Yeah, Alex, you bring up a great point about the IRA, and some of this is really hard to undo, to start rolling back some of these initiatives that are already taking hold. And let's be honest, the debate stage is very different from what happens in practice once someone's in the seat. Austerity rarely proves popular. It certainly didn't prove very popular in the 2010s. And it does feel as though there has been a bit of a structural shift in how some of these candidates and these parties are thinking about spending. So, if there is real austerity, that's surely one way to reduce inflation. But I'm a little skeptical that we're going to see a shift back to the 2010s austerity.
Well, sure. I mean, they're obviously very different. A different way, I guess, of asking that, and Megan, maybe this is for you, because you do see those higher rates. Are we going to see structurally higher inflation because of this kind of long-term spending, right? Like it's going to come off over the next 5 to 10 years, even if some of it sticks.
So we do expect that inflation will be, I think, stickier than people expect. But given our forecast that the Fed does hold for an extended period of time, we do think the Fed will eventually reach their goal. It's just going to take a lot longer than people have baked in. So, well into 2024, as we see inflation start to come down. I think for us, we're really focused on that trajectory and how that feeds into earnings. So people are forecasting an improvement in earnings into next year, which definitely goes against this whole goal of bringing down inflation and some of the deceleration that we've seen.
Yeah. Eric, what do you think? Structurally higher inflation at some point?
Yeah, look, a lot of these arguments, Alex, make sense to me. I mean, whether it's the building out of green infrastructure, the tailwinds from IRA and labor demand, certainly some other factors at play here. But some of the factors like structural, technological improvements, these things haven't really changed. A lot of the friendshoring, reshoring narrative is mostly just a narrative. It's hard to see that in the data so far. So I'm not fully convinced, but at least for the next 2 to 3 years, it's hard to get the genie back in the bottle. And I think you're looking at least more inflation volatility, perhaps around a higher average as opposed to a quick return to 2%.
Well, that's a really more inflation volatility. That's a good one. All right, guys, thanks a lot. Really appreciate it. It was fun to catch up with you, Megan Robson and Eric Nelson. Thank you very much. Coming up, the morning calls and later NVIDIA providing the latest fuel for the equity rally. We're going to dig through the results with Dan Ives of Wedbush. Plus, looking ahead to Chair Powell and hit with Clear Harbor's Aaron Kennan. That is also coming up. This is Bloomberg. This is the countdown to the open. I'm Alix Steel in for John Farrow. Time now for morning calls. A look at some of the top analyst recommendations on Wall Street this morning. First up, Bernstein downgrading Estee Lauder to market perform, seeing a challenging macro environment and headwinds to growth. Next up, Wolfe Research upgrading Discover Financial to outperform, saying recent declines have created an attractive buying opportunity. And finally, NVIDIA, the only remaining bear, throwing in the towel. Morningstar upgrading shares to hold following its blowout results. Just how much more upside can we really have in the stock? All right, coming up, it is the godfather of AI delivering in home run fashion. That is a quote from Dan Ives of Wedbush. I know this is a shocker. He's bullish on tech. More with him next to the opening bell. This is Bloomberg. This is the countdown to the open. I'm Alix Steel in for Jonathan Farrow. So we're moments away from the start of trading. Let's look at how we're set up here. The NASDAQ 100 futures are up by about 0.9%. It is definitely going to be a tech rally today led by NVIDIA, but small caps are trading a little bit heavy, which leads me to other asset classes. So switch up the boards here. You hear the opening bell there for the equity market. If you flip up the boards, though, you can see what's happening with euro dollar. So overall, a stronger dollar. How much can that continue? Except when it comes to the lira. The lira sort of really jumping higher here as the Turkish central bank surprised with a very strong rate hike. Also, yields are trading higher, particularly in the front end. You got the 2-year up by about 5 basis points. You can wonder if that's going to eventually put some pressure on tech, or if the NVIDIA story can really outweigh that. And commodities trading a little heavier, of course, because you got the stronger dollar. Again, are we overextended, though, going into Jackson Hole when it comes to the currency? So let's get to the main story. You got NVIDIA. That's going to really lead and dictate the market for the short term. Shares hitting a fresh record high on the back of those blowout results and stronger than expected outlook. The CEO saying a new computing era has begun. The race is on to adopt generative AI. Bloomberg's Ed Ludlow joining us now from San Francisco with more. Hey, Ed, what do you make?
Good morning, Alex. Well, NVIDIA's opened up more than 4%, not the same level of gains that we saw in after hours and pre-market, and just shy of $500 a share, now $490 a share. But if these gains hold, we will hit a fresh record on this stock. This was the third consecutive quarter where the sales forecast given by NVIDIA came in way above analyst expectations. What they're saying for the fiscal third quarter is sales will be $16 billion US, plus or minus 2%. I think most analysts were expecting around around 12.5% figure. In the fiscal second quarter just gone, data center sales coming in above $10.3 billion. The average analyst estimate was $7.98 billion. The growth is coming from the United States when it comes to data center. HGX, which is largely server designs, including H100 and A100, are doing well there. But it was interesting to note that at this time, China still accounts for 20 to 25% of data center revenues, which is within NVIDIA's historic range. What is happening? Well, you outlined it. Jensen Huang talked endlessly, frankly, about the shift to accelerated computing and the response to generative AI. And several analysts had a stab at saying, can you quantify that for us? How confident are you that this will continue indefinitely? The response was they have visibility on demand into next year. Supply is improving. Even if US export restrictions on technology to China in the first instance are adjusted, there won't be an immediate impact. But long term, what they said is if there is a long-term restriction on technology exports to China, it will be, quote, a lost opportunity for US chip makers in what is, frankly, the world's most important electronics market.
Ed, good stuff. Thank you very much, Ed Ludlow, joining us. Let's turn to some other movers here in the retail sector. It's really confusing. Guess topping the earnings estimates and boosting its full-year outlook. The CEO quote saying, our strong performance gives us confidence to deliver in the second half of the year. We're committed to managing our capital efficiently and expect to generate strong cash flows. Bloomberg's Abigail Doodle joins us now with more. I got to say, I did not expect this from Guess, and Dollar Tree not doing as well.
It's interesting. Such a mixed bag, no pun intended, for retail this quarter. It's hard to make heads or tails of the broader trends because we have companies that are doing really well, like Guess, and I agree with you. I would not have guessed that this at all. Again, no pun intended, given the fact that the stock was into today down more than 11% on sort of lackluster performance. But they put up basically a blowout quarter, strong right across the board. Sales, gross margin, and earnings all came ahead of consensus. Earnings beating by 82%. And it's not a tiny number either, Alex. Up 72 cents per share in adjusted earnings. And again, Asia strength, licensing for its European units. And at least some analysts, Jefferies in particular, thinks that the Asia strength could go ahead. I will note one thing, though, Alex. There is a 26% bearish short interest on this stock. So some of this move today, it could be a short squeeze.
Okay, fair enough. Really good context with that. Abigail, thank you very much. Although their commentary was still pretty good. All right, switching gears to the materials sector. We're following U.S. Steel. The stock is falling for a second day as another potential buyer backs away. So the CEO is saying that Esmark respects the position of the United Steelworkers and maintains a solid relationship with the organization and the leadership. That's, of course, from one of the bidders coming in for U.S. Steel is now walking away. Isabel Lee joins us with more. Isabel?
Hi, Alex. This is really an interesting story because Esmark is indeed not pursuing a takeover of U.S. Steel. The reason? To respect the rival bid of Cleveland-Cliffs. So Cliffs offered a takeover of around $7 billion, which U.S. Steel rejected. U.S. shares are now down by slightly 1%. It paired earlier losses. On Wednesday, it closed 2.2%, which is lower than the 35 per share proposal of Cliffs and Esmark. So the drama began on August 13 when U.S. Steel revealed it was reviewing proposals. And then hours later, we had Cliffs disclosing a takeover, and a day later, we have Esmark saying it will announce an all-cash proposal. But as we know, both those aren't panning out. And what's interesting here is Cliffs has a backing of a powerful labor union, and this labor union represents many of the workers at U.S. Steel. And now we know that based on a contract, the seal of approval of the labor is important and vital for the eventual suitor of U.S. Steel. Shares are now trading around, 1.5% lower, but year to date, it's up around 23%, Alex.
Isabel, thanks a lot. Isabel Lee joining us there. And finally, got Boeing reporting an issue affecting its 737 MAX jet, raising concerns about its delivery target. I feel like we've heard this story before. The company writing, quote, during factory inspections, we identified fastener holes that didn't conform to our specifications in the aft pressure bulkhead on certain 737 airplanes. Bloomberg's Simone Foxman joins us now with more. Simone?
Yeah, another story we've heard before is problems with Boeing's largest supplier, Spirit AeroSystems, and that apparently where these issues are coming from. This adds to challenges for Boeing in trying to get back to its 38 jets per month pre-COVID level target that it wants to produce. It's been trying to ramp up 737 production to that. JP Morgan and Jefferies analysts both believe that it will take the company a bit longer to reach this pace. You know, the good news is the FAA says this is not a safety hazard, but this is really offsetting some positive news that we also heard after hours yesterday, that Qantas was ordering 12 Boeing 787 Dreamliners. That's doubling the number that it has. A report by Air Currents, though, saying that this could potentially affect hundreds of misplaced holes, duplicate holes. So we'll try and get more information on exactly how long it will take for the company to address this problem. But shares now down 3.5%.
Simone, thanks a lot. Simone Foxman joining us there. Let's turn back to the stock of the day, and that's NVIDIA. So shares did hit a record high after earnings, but as Ed was pointing out, we're kind of rolling over here from that high. Dan Ives over at Wedbush writing, quote, NVIDIA's guidance and commentary was a drop the mic levels. This AI demand story is as real as any tech trend we've seen in the last 30 years, only comparable to the internet in 1995 and Apple's iPhone launch in 2007. Dan Ives of Wedbush joins us now with more. Dan, first, let's just go to the price action today. What does it tell you if it's sort of a buy the pre, sell the post? I mean, if we don't hold on to these record high levels, does that tell you anything about the short-term direction of the stock?
Oh, yeah, I just think this is knee-jerk. I mean, this is just the start of the appetizer in terms of where I think the stock's going. I mean, this was a historic guidance that we saw from the godfather of AI, Jensen, NVIDIA. And I think it just shows this tidal wave of spending is not even in the first inning, it's in the dugout.
I hear you. And my joke in the morning meeting today was like, Dan Ives is bullish on tech? Because you're always really bullish on certain tech names, right, Dan? And I'm wondering, how do we know this is just not a cyclical part of the tech industry? It's just a different kind of cyclicality. How do we know that?
Yeah, it's a great question. I can just tell you, in the last 30 years, we've never, not even within miles, have seen guidance raises of this level for a company the size of NVIDIA. And I think what that just shows, it's $1 trillion of spending coming around the corner. And we think it's the biggest transformational tech theme since internet 1995, maybe you could say 2007 iPhone. And now it's the second, third, fourth derivatives of AI. The front lines in NVIDIA, that's the godfather.
I hear you, but how do we know that it's going to be a continuous kind of build out? There's not a lot of like upfront spend, and then maybe we have some recurring revenue, but it's not going to be continuous and upgraded. How do we don't really know that though?
Yeah, and that's why we've spent the last call it 9 months on the road, in terms of trying to figure out around the world where these budgets are going. We think going into next year, it could be 8 to 10% of budgets AI, from less than 1% today.
Wow.
And that's why as a tech team at Wedbush, we've just been pounding the table across semis, across chips, across internet. And because I think it's really the start of a new tech bull market. I think the bears, they came out of hibernation mode, those beaten down bears the last few weeks. I think now they go back into those caves.
What did you make of the buyback? So typically when a large tech company does a large buyback, the conversation is, ooh, they see no other investment opportunity. What do you think of that?
I think they're just in a position of strength. I mean, they're generating more cash than some countries over the coming years. This was a smart move. Strategically, I think from a board perspective on the buyback side, they still could do M&A as well. But I think it's something investors wanted to see. And you just go take a step back. I mean, this is probably more pressure than I've seen on any earnings call in the last 15, 20 years. And they delivered home run fashion.
All right, Dan, if I haven't bought NVIDIA yet, do I need to wait or do I need to chase?
I mean, I think this is an name you buy today. I mean, that's sort of our view. I mean, you could be looking at a name 1.5, 2 trillion in terms of where it goes. But derivative plays, for those that maybe you feel like they missed it, the second, third, fourth derivatives, names like MongoDB, Palantir, Microsoft, Google, among others, AMD, and what Lisa Su are doing. I mean, this is going to be, I think, the next 3 to 5 years, something unlike we have ever seen in tech.
Dan, love it. Thanks a lot. Really appreciate it. Also like that shirt. Dan Ives over at Wedbush. Thank you very much. All right, let's continue the conversation now. We got Clear Harbor's Aaron Kennan. He joins us. Hey, Aaron, if you haven't bought NVIDIA, if you haven't bought into the AI trade, are you chasing it today?
Well, I think it's a longer term trend, as Dan outlined, that has really commenced, over the last many years, and it's just accelerating with this generative AI movement, and NVIDIA is at the epicenter of it. And so we have exposure directly and indirectly here at Clear Harbor to the AI trends. And as Dan suggested, it's not just an NVIDIA story. It's a software story. It's a hardware story. It's about ultimately increasing productivity at the work level, and it has repercussions at a macroeconomic level around things like GDP. So we're certainly very focused on it.
What is the risk to it? So if you were in NVIDIA, or if you need to chase it, or it has such a pivotal moment in the tech industry, where's the risk and how do you manage that?
Well, I think NVIDIA is cheaper today on a multiple of future estimated earnings than it was even a year ago, even though the stock price has rallied significantly. With that said, I'm not beating the drum on NVIDIA per se, but I'm just making the argument that we have to keep our eye on the earnings side and the expected earnings side of this trend. And certainly, if you look at the forward multiple of the S&P 500, with estimated earnings this year at $222 for the S&P, that's over 20 times. One could argue that the market certainly is not attractively priced right now, but one could also argue that we're overweight things within the growthier parts of the economy within the S&P, like we haven't been for many years, or perhaps forever. And so that higher multiple can be somewhat justified.
Do you think that it can reignite animal spirits in the equity market? As in, if the window for a sell-off in stocks is closing, do you have to play catch-up? Like NVIDIA is supporting S&P enough that you have to then play catch-up to that?
Well, Alex, I think if you look at just year-to-date, the broad S&P 500 equal weighted is only up just over 5% on a year-to-date basis, and the S&P is up 17%, with the NASDAQ up, 31% maybe as of the open this morning. And so the rally has been led not just by NVIDIA, but by large mega cap companies that are proving that they, even as they approach 500 billion market cap, 1 trillion market cap in the case of NVIDIA, that they can continue to grow. We are cautioned by the reality, though, that the broad market has not really rallied significantly this year. The Dow's up mid-single digits. As they say, if you look at the value line index, it's up about 5%. That's very lackluster when you then pivot and look at the growthier names through the NASDAQ index prism.
Yeah, fair enough. Sort of a dose of reality to that hype. We're going to get more into that. Aaron Kennan is sticking with us. So coming up, retailers under pressure as consumers start to feel inflation pains.
There are cracks of the consumer. Yes, the consumer remains strong overall, but there are pockets of weakness. We do expect consumer spending to start to slow.
Dollar Tree, the latest victim of profit pressures and theft. That conversation up next. This is Bloomberg.
I do ask myself if, this story of resilience in the U.S. economy is really dependent on the continued resilience and health of the consumer. We are seeing signs that consumers are coming under pressure. You're beginning to see the consumer bend more so than break, but obviously that does suggest tougher times ahead for the overall U.S. economy.
As I keep saying, I am on a budget. That was JP Morgan's David Lebovitz on the state of the consumer. Retail earnings definitely taking a hit. The latest victim is Dollar Tree, missing analyst estimates. The CFO, quote, writing, factors like sales mix and elevated shrink continue to pressure margins. Meanwhile, Nordstrom's and Gap reporting earnings after the closing bell. Simone Foxman is back with us. I thought Dollar Tree was kind of where you go when things are bad, which was confusing. Simone, what did you make the numbers so far?
Yeah, and to that point, the CEO is saying that 5 million new consumers, with 2.6 million of those customers having a household income over $125,000. So that suggests that there is some trade down, some move to Dollar Tree, but it's not offsetting the decline in profit margins. And that's really the concern here. Dollar Tree talking about how how consumers are increasingly buying their consumables, their food products from them, but those are low margin products. products. And then, of course, you have this mention of shrink. We heard it from Dick's this quarter. We thought that was the one everyone was really going to focus on, but now we're also hearing it from Dollar Tree.
Yep, Simone, thanks a lot. Appreciate it. So all eyes are going to be on Chair Powell speaking in Jackson Hole on Friday. Clear Harbor's Aaron Kennan writing, quote, the Fed is poised to pause in September and continue to assess the balance of disinflationary pressures, employment, and stronger than anticipated growth. This will be the message out of the Fed in Jackson Hole. Aaron is still with us. All right, Aaron, help me tie in the PMIs over the last 2 days, the numbers from retailers, into how that's going to feed through to what Jay Powell says tomorrow.
Yeah, I think you're seeing the average consumer feeling a bit of a incremental tightening when you look at their own personal balance sheet. You look at the savings rate, excess cash, it's trending significantly lower. You know, it hasn't been where it is for quite some time now, well, into, sort of the possibility of a recessionary period. You look at, sort of the revolving lines of credit on their credit cards, they've been extended. You look at auto delinquencies are up. And jobless claims, well, this morning were sort of roughly as expected, but, have been elevated recently. And I think, the big question for, the market is when will employment really crack so that the consumer really feels the pinch. And we know monetary policy, Alex, works with a lag. If you look at the mortgage market, for example, 61% of mortgages have an interest rate of 4% or less, and 81% have a rate of 5% or less. And the average mortgage, if you were to buy a home today, is about 7.5% on a 30-year fixed rate. So if the rate structure remains the same, even with unemployment where it is today, there's going to be, further tightening on the consumer side.
Aaron, taking into account the PMIs, the services in particular from yesterday, clearly the gap between manufacturing and services is starting to close, but services really haven't gone into contraction territory yet. Do you think that that's bleeding through into the job market yet?
Well, you're right. I mean, we saw 43 point, I think it was 7 on the manufacturing side, and just barely expansionary now on the services side. Europe, a different story, full contraction. But back in the U.S., I mean, certainly we're keeping a significant eye on the employment picture, and I'm sure the Fed is as well. But the Fed has done a lot of tightening, Alex, and it's not just in raising Fed funds, and it's not just in what we see in the rate structure of the United States. Quantitative tightening, reducing their balance sheet, we think is adding probably a good 100, 150 basis points when you actually think about the true Fed funds rate. So it's probably closer to like 7% here. And they've gone a long way. Headline inflation went from 9% back in June of 2022 to 3.2% today, and core is down 200 basis points over the same period. So, wait and see, monitor data seems to be the most prudent approach for the Fed here going into Jackson Hole.
Real quick, Aaron, what's your favorite hedge right now as we head into all this uncertainty?
Well, I think on the equity side, if you think that we're going to see a slowdown and that disinflationary trends will continue, utilities do look interesting because they're so rate sensitive. But I think the traditional sort of longer duration part of the Treasury market, I don't mean the 30-year, but closer to the 10-year, it does make some sense here. If growth really does disappoint to the downside, Treasury should rally. It'll give Fed relief, and maybe we even see them cutting next year. And so I think that certainly, when you think about sort of an equity fixed income balance, I think that sort of hedging component of high grade interest rate product makes sense here.
Aaron, thanks a lot. We really appreciate your insight. Thank you, Aaron Kennan, joining us there. All right, coming up, we got the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg. This is Bloomberg's The Open. I'm Alix Steel, in for Jonathan Farrow. The Nasdaq 100 losing a little bit of steam here, giving up some earlier gains. It's time now for the trading diary, what you need to be watching through the rest of the week. You got Nordstrom and Gap earnings coming out after the closing bell. It's been a bit mixed bag for retail earnings. Plus, Chair Jay Powell will be speaking from Jackson Hole on Friday. It's the main event at 10 a.m. Eastern. All right, let's go to next week. We get the JOLTS data on Tuesday. We also get U.S. core PCE and GDP coming on Wednesday. Heavy lift day. day. And finally, rounding out the week with U.S. payrolls report next Friday with like the 3 people in the world who'll be trading on that day, on Labor Day weekend. This is the Countdown to the Open. Thanks for joining me. Jonathan Farrow is returning tomorrow for a special edition of Surveillance from Jackson Hole. That starts at 8 a.m. Eastern time, so don't miss that. In the markets, you're looking at S&P really trying to hold on to some gains. The NASDAQ kind of giving up a lot of its oomph and as we head into the trading day. You have safeties, real estate, utilities, the top sectors within the S&P. You got energy and consumer discretionary on the downside. A little bit of a push and pull. This is Bloomberg.